Hey traders, this is Blake Morrow with Trader Summit. With me once again, it's Friday. I have Jim Welsh with Macro Tides. How are you, Jim? Good to see you.
I'm doing good, ready for a weekend, as I suspect you are too.
I am, and you know what I'm preparing for, and I'm hoping you're going to help prepare us is for next week. We've got a big week with the FOMC. We also have the Bank of England. A couple big central banks meeting next week. I know you're going to have a lot to say about the Fed, but what do you say about this price action that we're seeing in the markets right now?
Well, we're seeing a lot of extreme action. As you talked about 2-3 weeks ago about the yen, obviously the euro has kind of been under a lot of pressure. Equities are under pressure. So again, I think part of it, Blake, is people starting to realize and appreciate that with inflation at 40-year highs, the Fed is actually going to follow through. They're not just talking the walk, they're going to actually walk the talk, and they're going to do stuff. And other central banks are following.
Yeah.
So historically, you don't fight the central bank.
Right. And that's something that I've heard, my 20 some odd years of trading is don't fight the Fed, don't fight the Fed. And in this case, this is where the Fed doesn't have your back. And that's kind of what the market, I think, is coming into that realization. It's interesting also, Jim, I've had a lot of conversations recently with people that have been citing that, look, there's a lot of traders and a lot of participants out there that have not been around for years and years. And that they may have, they've basically cut their teeth in markets that, that have been very accommodative over the last 10 to 12 to 13 years. So, a lot of people are in for a rude awakening that they're finding.
Yeah. And I made that point myself in the sense, back in December, my expectation was the S&P would drop by 10 to 15% as the Fed shifted to a more less accommodative policy. And they've really, I think, been unbelievably clear in terms of what they intend to do. So are we going to get a 50 basis point hike next week? Absolutely. Will they talk about a 75 basis point? I'm sure they will. But the Fed, and this is something that people really need to comprehend, the Fed really believes that forward guidance is one of their primary tools. And what they want to do is do actions after they've prepared markets for those actions. And so that's why, to me, 75 basis points is very unlikely to happen next week, because the Fed hasn't really prepared. Bullard has brought it up, but I haven't heard other members of the FOMC back him up on that. So they will talk about it. They will prepare markets for another 50 basis point hike in June. And I think the other issue that people have to appreciate, the Fed almost across the board, doves, hawks, have talked about the need to get the Fed funds up to a neutral level, which is about 2.4, 2.5, give or take. That implies to me, Blake, that we could see 4 consecutive meetings of 50 basis point hikes. And as you know, 2-3 months ago, I was talking about they're going to front load this. They're going to have a hike in March, May, and June. At that point in time, before the Fed really got very, vocal about all this stuff, it was, my expectation was 25 basis points. I'll remind listeners, back in January, when I was saying that, Goldman Sachs was, we're going to have 1 increase every quarter. And I said, that's ridiculous. With inflation as high as it is, they can't do that. So anyway, I think people are going to be surprised that the Fed has to follow through. They're going to follow through. In terms of the S&P, very quickly, as I noted, going into this year, I thought the S&P was going to drop 10 to 15%. It did. When the S&P got below 4150, I had advised people to put some money to work, invest. When it got up near 4,600 in the first few days of April, I suggested it was time to take money off the table. As you know, my belief has been is the S&P was going to go down again to 4115. I think we're going to take that out at some point in time. So you're going to get, bear market bounces, if you will, when the market gets pretty deeply oversold, which is exactly what happened earlier this week and why we had that bounce.
So, it's interesting that you point out that 41.25 or just below like recent lows. So your idea here is still, and I'm gonna backtrack us a little bit on some of our most recent interviews together. You've talked about the S&P hitting new lows, which they are getting really close.
Flirting, yeah.
But yeah, they're flirting with them, and so you've been spot on here. But you're also calling for a rally to new highs after this. So
Yes.
you expect a dip down to 4,100, but then when you say new highs, are you talking all-time highs?
Yeah, I am. And I think there's potential that this decline could extend down to about 38.50. That's the 382 retracement from the low in March of 2020 to the high in January of this year. And that call is predicated on, I'm still not in the recession camp. So GDP came out, it was down minus 1.4%. But then when you look at trade, subtracted 3.2%. Why? Because we're importing a record amount of stuff. And so from an accounting standpoint, Blake, they're measuring domestic production. So anything that's coming in from outside the country is excluded. So, but at the same time, that's kind of misleading because it shows that demand was really, really strong. And at the end of the day, overall aggregate demand really is the better indicator of what's happening with the US economy. And so when you factor out that aspect of it, you realize that, hey, consumer spending, I think, was up near 3%. So the economy was much stronger and is much stronger than that implies. So my whole predication on going to new highs is that we don't have a recession. And I still think that that is a good base case. The key is going to be the Fed is going to push the funds rate up to 2.25%. Now, do they get some help 6 months from now from the things they can't control? Are we going to see supply chains really ease up? Computer chips ease up? Is the demand for labor going to ease up in the U.S. labor market? Nobody knows this stuff. So to me, if we're going to see a new all-time high, somewhere along the line, the Fed has to hit the pause button. And if they're not able to hit the pause button, we're not going to see new all-time highs. It's that simple.
Yeah.
If they have to go above 2.5% on the funds rate, then I think we're in a whole different ballgame. And one of the reasons is, if you go back and look at a chart of the Fed funds rate from 1981, we've always made lower lows in terms of the peak rate at which the Fed stopped tightening policy. In 2018, it was about 2.4%. So to me, if the Fed has to, for whatever reasons, go above that 2.5% level, you're breaking a downtrend that's been in place 40 years. That's pretty significant. And I don't think the market could respond favorably, if you will, to that. Okay. So why, to me, it was like raise cash here because the downside, is going to be fairly decent. And on the rally, when we got up to near 4,600, it's like, okay, we were oversold. Now we're modestly overbought. Time to lighten up. And I think that's what we need to do is bob and weave a little bit as this all plays out, because the Fed doesn't know what the terminal funds rate is going to wind up being, and nobody knows. Well,
you brought up this chart of the 10-year. So what are we looking at here, Jim?
Okay, this is a 10-year. And one of the things I wanted to focus on, and if somebody goes back and looks at the S&P chart, the red line is the 5-day exponential moving average on the 10-year treasury. The darker green is a 13-day moving average. So to me, this is one of the risk management tools that I think is really very helpful. So that when a market is making a high or low, you'll see divergences on the RSI. And that's like a forewarning that a trend change could potentially be developing. So if one is looking to establish a position, to me, when you start to see RSI divergences, you take a 1/3 position, a partial position based on that technical evidence. The key then is waiting for prices to confirm that indeed a top or bottom has formed. And this is where the 5 versus the 13 becomes really helpful. So you can see over the last 6-7 months that prior to this big surge in yields since early March, the 5 crossed, the red line crossed above the green in the first week of March, and it's still above it. So this is to me, a better trend following methodology, way better than, I'm going to look at the 200-day average. To me, it borders on useless. And yet, that's one of the things everybody loves to talk about. So we're not there yet. We see some divergences, as you can see on the RSI in the 10-year. If those persist, and then we get a confirmation where price the yield starts to come down, so the 5 and 13 cross, then, again, my expectation is at some point in time here, we're going to get more and more data that shows the economy slowing. I think that's going to be helpful to the bond market. And I think inflation is going to top out, at least statistically, at this point in time, just because of the 12-month rate of change on the base effects. So it doesn't change the bigger picture of what the Fed's going to do. It just, I think, means that you have an opportunity that bond yields are going to come down for a period of time. And then, how low? I don't know, 250, maybe 230 on the 10-year. We'll see. 250, right. I think, is probably not a bad guess.
All right. Well, we'll see if we get a little bit of a pullback in the 10-year. But going back into next week, with the Fed, you brought up the chart of the euro, and the euro has absolutely gotten destroyed. We're trading down at near 105. We are, holding below the lows that were created post-COVID lockdown in 2020. Right. The spike low of the euro was down around the 106, 20, 30 level. We're holding below that right now. It looks like we're going to close the weekend below that. What do you make of this euro? I mean, are you a buyer here? Yeah. I mean, this is, you might be looking at the euro and going, well, yeah, I'm going to trade the euro, but we do have the risk of the Fed next week. How are you going to play this?
Well, again, going back 2-3 weeks ago, we talked and I said, hey, at 108.50, I think that's a good entry point on the euro because it was oversold. At the same time, if you look at the RSI, the bottom panel, you can see where that line is drawn on the euro chart, the horizontal line. So it was making lower lows than it had in February, and the RSI was better. So, okay, time to take a partial position. But notice that rally that took place off that little trend line failed, and the red 5-day moving average didn't cross above the 13-day. And so when you took out that horizontal, those lows, to me, that's where stop is, which was around 107.50. So going long at 108.50, out at 107.50. Right now, we have no divergences on the RSI. And the one thing I forgot to do this, but the euro had a decline fairly significant. If you want to put up like a 6 or 7 year chart, if that's possible, Blake.
Yeah.
Looking at this the other day, and then it just, when we were, when I was getting ready for our conversation, I didn't think of doing, I wanted to focus on this stuff. So if you can go back a little longer than that, like 6-7 years.
Let me give you a fresh chart, Jim.
Yeah. Thank you. Sorry. We're doing this on the fly, folks.
No, that's it. That's all right. I'm trying to.
So I think that chart wasn't too bad that you had up there. So when I looked at this, Blake, it was kind of like, okay, you can see that big decline from 2018 down to the lows in early 2020. So what I wanted to do, and I just forgot to do it, is look at the length of that decline and then subtract it from the high that was made in early 2021. That potentially what we're doing here is a big A down, B up, and now we're in the throes of the C wave that should undercut the low from 2020 by a similar amount that it fell short in 2021 at that high. So the difference between that. So
this would be an AB equals CD, which you can see drawn out right now, which will take us right below these lows here. And
yeah. So to me, that's the one thing that's like, okay, there's a projection that we can make in terms of the euro getting down to that level.
Yeah.
Looking for a bounce, retesting that level. And so you get ideally some RSI divergences, and then wait for the 5 and 13-day moving averages to cross. So to me, this is what one should be waiting for, is to approach that equality level and then look at the daily indicators to identify when momentum seems to be starting to wane.
Well, and if you think it through, Jim, next week when we do have the Fed, the Fed, let's say they deliver a 0.5 basis point as you are expecting, the market may get that initial knee-jerk reaction of dollar strength. We could create a new low around the 104, let's just say 104.25 level, and that might be your level to go long on an AB equals CD move, if I'm putting it all together.
Yeah, irrespective of what drives it there. The market will always find reasons to get to price levels sometimes.
Sure.
The other thing, I'm trying to remember, I can't remember the exact year. I'm thinking I don't know if it was 2015 or so. I think, didn't the euro make a low under 104 sometime in the last decade?
Yeah, in the last decade,
Like 103.60 or something. I don't know.
Yeah, it's, well, you know, you look at June 2016, we went as low as
Yes.
103.30. So that is correct.
Okay. So to me, that's another reason why starting to look for another trading low to come in here. To me, 108.50 was one of those areas, but didn't work. Now it's time to look, I think, down there between, you know, the C equally A measurement and that low.
Well, you know, a lot of people are trying to find a bottom in the euro, and maybe, just maybe, based on your analysis, Jim, we may have found a good place to be.
The parameters,
yeah,
the parameters, basically. Because again, at some point in time, Blake, the emphasis shifts from, oh, this central bank's being more aggressively tight than this central bank. And so the first currency, you know, in this case, the dollar is rallying because of what people perceive the Fed's going to do. And then it comes, wait a second, if the Fed does that, the economy is going to slow down. Well, Powell has said, we can't address supply side issues. We have to address the demand side, which is why we're going to raise rates. They're trying to curb demand, which means an economic slowdown. At some point in time, attention is going to start to shift. Well, how much is the US economy going to slow down? I do believe, I'm not in the recession camp at this point, but at some point in time, there's going to be a recession scare, because we're going to get a bunch of data that shows things are slowing, legitimately slowing, not like the GDP report. And yet the Fed is going to continue to talk hawkishly. People are going, oh my God, we're going to go into recession, you know. And I think that's when people start to think, okay, maybe it's time to lighten up on the dollar.
yeah.
You know, US economy is going to, you know, pay the price for what the Fed's doing.
All right, Jim. Well, I tell you, I appreciate the fact that you're putting it all together for us traders. So as a trader, how do I find out more about what you do on a daily basis?
Macrotides.com. And if you want a sample issue of one of the recent weekly technical reviews, jimwelshmacro@gmail.com. And you can kind of get a better taste of, you know, what I do.
You know, and I love it because you do send out updates to your subscribers throughout the course of the week if there's something that has materially changed. And I think that's important to do with your base of fans. So
yeah, Jim, when volatility picks up, things change.
Yeah, they do. So thank you so much for spending your time with us every Friday. I know a lot of traders love to look forward to this specific show that we do. So if you like what Jim does, make sure you give him a thumbs up, subscribe to the channel down below if you haven't done so already. Jim, have a great weekend. Thanks for joining us once again.
My pleasure, Blake. You have a great weekend as well.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.